Palisade Radio is brought to you by First Majestic Silver Corp, one of the world's purest and fastest growing silver mining companies.
Welcome to another episode of Palisade Radio. This is your host, Colin Cattell. On the line with us today is Jim Rickards, best-selling author of Currency Wars and The Death of Money. He really needs no further introduction, so Jim, welcome to the show.
Thank you, Colin. Great to be with you.
Jim, your latest book, The New Case for Gold, I believe is slated for release on April 5th, just about a week away. Pre-orders via Amazon are already being accepted, and I was fortunate enough to get my hands on a copy, and I believe the book to be as captivating as your first two. Its release also comes at a very prescient time with gold and other commodities starting to get a lift. And one way that I would summarize The New Case for Gold is a defense of gold in the modern world. A lot of people, and Warren Buffett included, brushed it off as an ancient relic, and you beg to disagree. So, Jim, can you start off by spending maybe just a couple minutes expanding on the role of gold in today's monetary system?
Sure. Colin, you're right. First of all, thank you for the introduction. The book is called The New Case for Gold. Obviously, I have a copy with me, but it is available for pre-order on Amazon right now. And the title itself has a little bit of history. It's called The New Case for Gold, but you go back to the late 1970s, around 1980. Of course, President Nixon suspended the redemption of dollars for gold by U.S. trading partners in 1971. It took a couple of years for gold to be completely pushed out of the international monetary system. It was in 1974. When the IMF officially demonetized gold and we went into this brave new world of floating exchange rates. But in the 1980 presidential campaign, that was Ronald Reagan versus Jimmy Carter, not that long after the events I just described, really just about 8 years or so, there was a lot of pressure, strong movement to go back to a gold standard. And, of course, Ronald Reagan was conservative and was being pushed in that direction. So what President Reagan did after he won election, he didn't say we'd go on a gold standard, but he said he would appoint a commission to study it, which he did, a high-level blue ribbon bipartisan commission, Republicans and Democrats. And they studied the situation, reported back, and the commission as a whole came to the conclusion that the U.S. should not be on a gold standard. But there was a very strong minority on that commission, consisting of some prominent Americans, including Ron Paul, Lou Lehrman, and others, who, of course, felt that we should be on a gold standard. So, as often happens, they were allowed to write a minority report. It wasn't, the majority report recommended no gold standard, but this minority report recommended the opposite. Well, that was a public record because it was a commission. So the minority report, some enterprising publisher took the minority report and published it as a book called The Case for Gold. And that's a minor classic, sort of a cult classic among gold bugs. They'll still refer to the book The Case for Gold. So my book, The New Case for Gold, obviously both plays on that title and is a tribute to the original work on that, the Case for Gold, which was, as I say, this minority report. Now, what's new in The New Case for Gold? There are sort of the old arguments that have been around for decades, and I talk about those. But there are also some new arguments for owning gold that were not around at the time of the minority report in 1981, that were not even around 10 years ago, not even 5 years ago. And these involve things like cyber financial warfare. As you may know, I do quite a bit of work for the U.S. intelligence community, national security community, and the Defense Department in the area of financial war and financial threats and cyber financial threats, all very important subjects. And, you bump into, I bump into a certain number of billionaires, and I ask them, I say, well, tell me about your portfolio. And they say, well, I own these stocks and these bonds, and I've got this and I've got that. And I say to them, well, no, what you have are electrons. You may get a paper statement in the mail from your broker or your bank once a month, but all of your assets are digital, and all of them are completely vulnerable to hacking by enemy cyber brigades. Vladimir Putin has a 6,000-member cyber brigade operating on the outskirts of Moscow, working day and night to be able to hack, disrupt, destroy, delete, and otherwise shut down U.S. exchanges, U.S. financial assets, et cetera. So if your wealth is digital, be it stocks or bonds, it can be completely wiped out overnight, and good luck restoring it. Whereas if you have some physical assets, and it can be gold, but also silver, fine art, land, or private contracts. Private equity is a contract. You don't need a digital certificate to prove it or a digital exchange. That's just a contract. These are all kinds of assets that are not vulnerable to hacking, not vulnerable to being wiped out. And, I say things like this and people go, oh, well, that would never happen. Well, it happens all the time. I mean, there is financial warfare going on right now between Russia and China involving Ukraine. The United States Justice Department just indicted 5 Iranian hackers last week for attacks on U.S. banks. Talk to the country of Bangladesh. I mean, Bangladesh is one of the poorest countries in the world. They just lost $100 million to a cyber theft. And by the way, that money was on deposit with the Federal Reserve Bank of New York. It wasn't on deposit with some local bank or Bangladesh bank or Indian bank or even a prominent U.S. commercial bank. It was on deposit at the Fed, and $100 million disappeared that they could afford. And of course, if they had had those assets in gold, they would still have the gold today. So that's an example of an argument that was not around in the 70s, 80s, 90s, or even 10 years ago, but is very prominent today. There are other arguments also involving the war on cash, which there's been a lot of conversation about. We can talk about that if you like. But there are classic arguments in favor of gold, but there are new 21st century arguments in favor of gold. And that's why I call my book The New Case for Gold.
Thanks for that, Jim. And I think that you have a very fascinating writing style whereby you start out with a unique story or discovery in each of your books. And as an example, in Currency Wars, that was, of course, as many of our listeners will remember, the war game at the Pentagon, where you talked about how a currency war might play out between the major powers of the world. And in The New Case for Gold, you discuss your findings about the Fed balance sheet. And this is going to lead into some other questions I have, but reportedly the Fed has a high rate of leverage, 75 to 1. But you found a very interesting, area of the balance sheet most people don't look at, which has to do with the gold at Fort Knox. Can you talk about that a bit?
Sure. I always say that the Federal Reserve today looks like a really bad hedge fund. It's highly leveraged with a duration asset liability mismatch in duration and maturity, and technically insolvent if you just look at the bond portfolio on a mark-to-market basis from time to time. So the Fed's got a pretty crummy balance sheet. By the way, the 75 to 1 leverage, which is extraordinary. I mean, banks are leveraged, depending on the metrics, about 8 to 1 or 12 to 1. Wall Street firms are not allowed to leverage more than 15 to 1. The Fed was leveraged 75 to 1, but about a month ago, they gave back about $40 billion to the Treasury, and they cut their capital from roughly 60 million down to a number, it's somewhere around 35, 40 million. Actually, they had a little bit more than 60 million and gave a big slug back to the Treasury, about 40 billion, and they're down to around 40 billion or so today. So when you take that into account, their leverage is actually over 100 to 1 today. So a pretty lousy balance sheet. But one of the items on the balance sheet is a gold certificate. And you say, well, how did that get there? And what's the history of that? Well, the history is interesting. Going back to 1913, when the Fed was created, there were actually gold coins in circulation at the time. It wasn't that unusual for someone to reach in her pocket or his pocket and pull out a 1 ounce gold coin to pay for something. But most of the gold was held at commercial banks. So, and there was paper money in circulation, but that paper money was backed by gold and convertible into gold. Beginning right around World War I, little by little, banks started melting down the gold and turning it into 400-ounce bars. So you could still have private gold, but they made it more and more inconvenient. They say, well, we don't have coins anymore. You can own gold, but nobody's going to obviously walk around with a 400-ounce bar in their pocket. So that was step one, getting the gold out of private circulation into the banks. Step two was the Federal Reserve banks, which, by the way, is, of course, a private system. I think most listeners know this. The Federal Reserve banks required all the commercial banks to hand over their gold to the Fed. So now suddenly the gold went out of the commercial banks into the Federal Reserve Bank. Well, the Treasury had the last laugh because in the 1930s, the Treasury ordered the Fed to hand over the gold to the Treasury. This was at a time when the Treasury was confiscating all the private gold in the country. In fact, Fort Knox was built in 1937, partly to house all this gold that the Treasury was scooping up. They used to keep it in vaults in the basement of the Treasury on Hamilton Place, right next to the White House, but they ran out of space, so they built Fort Knox to do this. By the way, people think all the Treasury gold's in Fort Knox. That's not correct either. About half, a little more than half, is at Fort Knox, but the rest of the U.S. gold is at West Point, up the Hudson River in New York. And occasionally people say to me, "Well, Jim, who controls the U.S. gold? Is it the Fed or the Treasury?" I say, "Well, neither one. It's the U.S. Army, because both Fort Knox and West Point are Army bases. So the Army's got the gold under lock and key." But technically, legally, it belonged to the Treasury. So you can see the sequence. Step one, take the gold out of private hands, put it in private banks. Step two, take the gold from private banks, give it to the Fed. Step three, take it from the Fed and give it to the Treasury. But remember, the Fed is private and the Treasury is the U.S. government. And the Fifth Amendment of the Constitution prevents the government from taking private property without just compensation. So to get around that, the just compensation was this gold certificate that the Treasury gave to the Fed. To this day, the Fed carries that on its balance sheet. Now, the Fed values that at $42 an ounce, which, of course, that's the historic cost. That's an historic cost convention. But that was last revalued in the 1970s. Of course, gold today is around $1,200 an ounce, a little bit higher. But if you take the face value, the historic cost of the gold on the Fed balance sheet and divide it by $42 an ounce and come up with a number of ounces and convert that into tons, it comes out to almost exactly 8,000 tons, which is interesting because that's how much the Treasury owns. The Treasury says they have 8,000 tons. So it's as if the Treasury can't sell any more gold because they need to hold that much gold at least in order to back up this paper certificate that they gave to the Fed way back when to get around the Fifth Amendment to the Constitution. That's highly significant because what it means is that the Treasury can't dump any more gold if they want to suppress the price. They have to twist arms to get other people to do it. By the way, you look at the history of the Treasury ownership of gold. In 1950, the United States had 20,000 tons of gold. By 1970, we were down to 9,000 tons. Where did that 11,000 tons go? Well, it went to our trading partners under Bretton Woods. 3,000 tons to Germany, 2,000 tons to France, 2,000 tons to Italy, and so forth, smaller amounts to the Netherlands and Japan. That's where the gold went. It was around then, just a year later in 1971, when President Nixon, there was a run on Fort Knox. Clearly, the United States was going to be out of gold in a matter of years or less. President Nixon shut the window and ended the conversion of dollars for gold by our trading partners. But the U.S. still dumped another 1,000 tons of gold under President Ford and President Carter in the mid to late 1970s. And we prevailed upon the IMF to dump 700 tons of their own. So 1,700 tons, which is a lot of gold, from the United States and the IMF was dumped on the market in the late 70s to suppress the price. It didn't work. The price skyrocketed anyway. We all know it went from $35 an ounce in 1971 to $800 an ounce in 1980. But in 1980, suddenly the United States stopped cold. The United States stopped selling gold. We stopped at 8,000 tons. And what I talk about in the book is that very likely happened because the Treasury couldn't go below 8,000 tons because that amount corresponds to the amount on the Fed balance sheet. And by the way, if you take that gold, the 8,000 tons on the Fed balance sheet in the form of this gold certificate, market to market at $1,200 and add that to the Fed's capital, guess what? The leverage drops from 110 to 1 to about 12 to 1, 13 to 1, which looks just like a good commercial bank. So the secret of the Fed balance sheet is the hidden gold asset, which when marked to market reduces their leverage, makes them highly solvent. I had started out by exploring the fact that they were temporarily insolvent if you just mark the bonds to market. But when you count the gold, they become very solvent and actually decently leveraged. So the secret hidden asset on the Fed balance sheet is actually what keeps them from being insolvent and keeps them moderately leveraged. So, of course, nobody talks about this. The numbers are all there. It's not, I didn't like break into a safe and steal the information. You can look at the Fed balance sheet. You can look at a gold ticker. You can look at the Treasury deep storage gold. You can look at the history of the Fed and the Treasury and Bretton Woods and Glass-Steagall and a lot of other things. It's all there, but you have to connect the dots to see this hidden relationship between Treasury gold, the Fed gold certificate, and the solvency of the Federal Reserve. That's one of many mysteries that I unlock and explain, not deep, dark conspiracy stuff, but just, I think, good, solid forensic analysis and forensic accounting. That's all, as I say, it's all in the book, The New Case for Gold, and I hope the readers enjoy it.
Well, that brings me to my favorite quote of the book, and you write, "The confidence of the entire global system of finance rests on the U.S. dollar. Confidence in the dollar rests on the solvency of the Fed's balance sheet, and that solvency rests on a thin sliver of ... gold." This is not a fact anyone at the Fed wants to acknowledge or discuss publicly. You're almost suggesting, Jim, and correct me if I'm wrong, that the U.S. dollar is on some form of a gold standard at this point in time.
Well, I am suggesting that. You're right. And the point I make is that, we have different measures of money supply. There's M2, M1, M0, which is, base money. That's the money that the Fed prints. But I have something I call M sub zero. M sub zero is gold. The gold is still the linchpin, the underlying hard asset in the global monetary system, not just for the Fed. But, why does the IMF have 2,000 tons of gold? The IMF has almost 2,000 tons of gold. Madame Lagarde, head of the IMF, has nothing good to say about gold. She disparages it at every opportunity. Well, fine. Why is the IMF holding on to 2,000 tons of gold? Why does Germany have 3,000 tons of gold? Why is Russia acquiring thousands of tons of gold? Why has China tripled or quadrupled its gold supplies, gold hoard in the last 7 years? And when I say tripled or quadrupled, you have to speculate a little bit because China lies about their gold. They're non-transparent about how much they actually have. But we do have information from Hong Kong imports to China, mining output in China. There is some reliable information that you can use to form reasonable estimates. And it's clear that China has taken its gold reserves from reported 600 tons in 2008 to probably 4,000 or 5,000 tons today. By the way, when I say 4,000 tons here, 2,000 tons here, this is a lot of gold. There are only 35,000 tons of official gold in the world. All the central banks, all the sovereign wealth funds, all the finance ministries, Treasury, Fort Knox, all the official gold in the world, about 35,000 tons. So when you talk about buying 3,000 or 4,000 tons, which is what China has done, or over 1,000 tons, which is what Russia has done, and combine that, this is more than 10% of all the official gold in the world just in the past several years. So there's just a lot going on behind the scenes, but these countries would not be acquiring gold. They would not be holding onto their gold. They would not be manipulating the gold price. They wouldn't be doing any of this if gold wasn't critically important in the international monetary system, which it is. It's just that the central bankers and the IMF, they don't want to talk about it. The eggheads, the professors, the global monetary elite, the Marty Feldsteins, the Paul Krugmans, the Janet Yellens, Mario Draghi, Kuroda, none of these people who understand what I'm saying. I mean, this is all, as I say, very clear. They get it, but they don't want to talk about it because they don't want people to think about gold. Americans have been really conditioned over decades to stop thinking about gold, don't take gold seriously. There are all these arguments against gold that I actually talk about in the book. I shoot them down one by one. Colin, most of the book is in support of gold and either a gold standard, an official gold standard, but I also say, look, don't wait for governments to create a gold standard. You can go on a personal gold standard. Just take 10% of your investable assets, buy physical gold, put it in safe non-bank storage, and protect yourself and have a personal gold standard. The Russians are doing it. The Chinese are doing it. Are they stupid, or do they see something coming that most people don't see? Well, I've been to Russia and China, and I have a lot of friends in both places. They're not stupid. They see something coming. If it's good enough for them, it's good enough for you. What are you waiting for?
Jim, I have so many other questions left to ask you, so I'll try to get through just a few of them here. But you're adamant that the gold is indeed at Fort Knox, and I don't want to focus too much time on this point, but I know a lot of listeners have heard questions, even from people like Ron Paul, who you mentioned earlier in the interview, is famous for his Audit the Fed movement. Billionaire Eric Sprott, who we've had on before on the show, has also stated his belief, with quite a bit of math behind it, that somehow the gold has been leased out or sold. Any quick comment on why you think it is indeed there?
Sure. These are there's a lot of confusion on this subject. So let me just make a few, kind of plain statements, and then I'll talk more about it. I'm in favor of auditing the gold in Fort Knox. I've never been against an audit, but the gold bugs and the conspiracy theorists who say there's no gold, they say the reason the government won't audit the gold is because the gold's not there. That's actually a non sequitur. It's quite the opposite. If you're the Fed and the Treasury, and you want people to think that gold is unimportant, which they do, why would you audit it? And you only audit important things. You audit financial statements because it's the law, but it's important to stockholders. You audit things that are important. You don't audit things that are unimportant. So if the Fed wants you to think that gold is unimportant, it follows that they wouldn't audit it, because auditing it pays too much respect to gold. So I am in favor of an audit, just to be clear. But the fact that the government doesn't audit tells me that the gold is there. They just don't want you to pay any attention to it. So that's the first part of the argument. Now, as far as Sprott saying the gold's leased, it could be leased. That doesn't mean it's not there. Leasing is a paper transaction. If JP Morgan leases gold from the United States Treasury, which they do through the BIS, and that's disclosed in the footnotes, the financial statements of the BIS. BIS is the Bank for International Settlements, which is the central banker's central bank and the main intermediary for central bank gold transactions. That it's like an anonymity broker in stocks or bonds, or a dark pool in stock trading. That's what the BIS is. It allows central banks to transact in gold with each other without anybody knowing what's going on. So that's kind of what the BIS does. But believe it or not, the BIS has an audit, and they have footnotes in their financial statements, and you have to be a little bit of a geek like me to read them. But if you do, you'll find that they say we intermediate gold transactions between central banks and commercial banks. So we know what's going on. But if JP Morgan leases gold from the U.S. Treasury, it doesn't mean that they back up a truck in Fort Knox and drive the gold away. There's no need for that. It's just a paper transaction. The gold can sit in Fort Knox. JP Morgan can take a hypothecatable title. Now, once JP Morgan has the gold, what they do is they sell it times 100 to gold investors who think they have gold, but what they really have is what's called unallocated gold. Unallocated gold is a euphemism for no gold. So if I call up JP Morgan and I say, I want to buy $1 million worth of gold, they'll say, fine, here's our contract. Send us the $1 million. I sign the contract. I send the $1 million. They send me a confirmation, and it says I own $1 million worth of gold subject to the contract. Well, read the fine print in the contract. What it says is your gold is unallocated, which means that they don't claim to have any specific bar with a serial number or your name on it. And in reality, they've taken the same bar of gold and sold it to 100 different investors. Now, that's fine if we're happy with the paper contract, but if all 100 of us show up at JP Morgan and they've only got one bar of gold, the first person may get the gold. The other 99 people, they're going to get their contracts terminated. They're going to get a check for the value of gold at the close of business yesterday, but they're not going to get today's price movement or tomorrow's price movement when it's super spiking, going up to $2,000, $3,000, $4,000 an ounce. That's when you want your gold for the price protection when everything else is falling apart. That's when you're going to discover that you don't have the gold. You've just been closed out at yesterday's price by JP Morgan. They'll send you a check, but not let you participate in the price of gold from there. And they don't even have the first bar because that's sitting in Fort Knox. So do I agree with Ron Paul that we should audit the Fed? Yes, I do. Do I agree with Eric Sprott that a lot of the gold is leased? Yes, it is. I agree with that. But neither one of those things is proof that the gold's not there. The gold is certainly there. Actually, I have some evidence that the gold is there from other sources, from military sources. So my point is, this is why it's so confused, because yes, we should audit. Yes, the gold is leased. Yes, there's price suppression. I agree with all of that, and there's very good evidence for all that. It doesn't mean the gold's not there. The gold could be sitting there on a shelf in Fort Knox and still be leased out and unaudited. None of those things prove the gold's not there. And apart from those arguments, which are really non sequiturs, as I've just explained, I've seen no proof that the gold's not there, and I have seen some proof that the gold is there. But this is where the legitimate criticisms and conspiracy theories and sloppy analysis all get mushed up into this no gold thesis, when in fact, if you were the United States of America, why would you let the gold out of your sight?
Well, you just mentioned price suppression, and I want to bring the interview kind of to an end here by talking about the manipulation that you do believe is in place and this back and forth between China and the U.S., and you talk about this a lot in your book. But you say, once China has enough gold so that its gold to GDP ratio equals or exceeds that of the USA, it's not there yet, but once it is, there'll be no political reason to buy more. And I guess that's kind of the end game. And do you think, how far away is that? And then will the gold prices go up because the suppression by the U.S. and China ends? What's going on there?
Well, the gold price will go up on one way or the other. So sure, if the price suppression ends, that would create a vector for the gold price to go up. But all of the price suppression and manipulation schemes of the past, every one of them has failed. The London gold pool of the 1960s failed. The U.S. dumping of 1,700 tons in the late 1970s failed. The UK selling almost all of its gold failed. Switzerland selling thousands of tons of gold in the early 2000s failed. So all these price suppression schemes have failed. Gold is going persistently higher. So manipulation can work in the short run, but it never works in the long run. So I'm confident that the price of gold will skyrocket, will go where it's going to go, manipulation or no manipulation. But you're certainly right, Colin, that if the manipulation ends for other reasons, for political reasons, then that's just one less thing standing in the way of gold going a lot higher. Now, as far as the manipulation is concerned, again, I don't like speculation. I like analysis. I like empirical data. I like hard facts. I like science. That's how I do things. But the evidence for manipulation is overwhelming. I've actually met with Professor Rosa Blanches-Metz at New York University Stern School. She's the leading expert on using price signals and market data to determine if there's manipulation is going on. She's advised some of the lawsuits still pending involving manipulation. Her evidence is conclusive. She's written a report, not public yet because it's being used as evidence in these cases. But as I say, I've spoken to her firsthand, and the conclusion is inescapable. There's no other explanation for the price behavior other than gold. Other than manipulation of gold. I also spoke to a PhD statistician at a major hedge fund. He said the best way to make money the last 10 years is short COMEX gold just before the close and buy it just before the open the next day. And he said it's like clockwork. It gets squashed at the close and spikes at the open, squashed at the close, spike at the open, with some volatility around that. But that's clear evidence of manipulation. The odds that would happen based on normal market forces are infinitesimal. So he was actually surprised that more people weren't doing the arbitrage because the manipulation was so blatant. So, again, one PhD professor, another PhD statistician who have studied the data. Again, they're not conspiracy theorists; they're scientists who have come to the same conclusion. And there are others as well, but also, just kind of anecdotally or just inferentially, if you're China and you have to buy another 3,000 tons, which they do, they're trying to catch up to the United States. I estimate they have between 4,000 and 5,000 tons of official gold, but the U.S. has 8,000 tons. They need another 3,000. If you were out to buy 3,000 tons of gold, you wouldn't want the price to go up. You would want the price to stay down because you're a buyer. Now, once they get the gold and they're on a par with the United States and it comes time to reset the international monetary system, then no one will care what the price is because everyone will have the same amount of gold, both in absolute terms and relative to GDP. But we're not there yet. And if China is manipulating the market through COMEX futures, then they're beyond the enforcement powers of the United States. You can't subpoena China. The CFTC is going to get nowhere trying to investigate, behind-the-scenes Chinese behavior in the market. And I've spoken to senior officials at the IMF. When I say senior, I mean top-level officials at the IMF and in the U.S. intelligence community who are pretty relaxed about it. They think that it's a good thing that China is rebalancing their reserves away from what are called credit assets, meaning treasury securities, into gold assets. So people know this is going on. The data is available if you want to look at it. The U.S. And the international monetary elites are very relaxed about it. They think it's a good thing. If you're China, you want a low price until you get the gold. So these are the forces operating. These are the headwinds, if you will, operating against the gold price, but in favor of the gold price. are extreme physical shortages. I've seen this firsthand. I just got back from Switzerland, met with the head of the world's largest gold refinery. I've met with head of secure logistics, also in Switzerland for some of the largest gold vault operators, gold people who run armored cars and move gold around. I've spoken to miners. I crawled down into gold mines. I mean, I've been very involved in the physical side of the business, not as much as the paper side of the business. And this stories will make your hair stand on end. I mean, there are shortages. They cannot meet the demand. There's a waiting list for buyers. Shortages of sellers. One of the things he told me, one of the gentlemen told me, was that, if you've ever seen a 400-ounce gold bar, I've kind of physically handled them and been in these vaults. They've got stamps all over them. It's almost like a dollar bill. It's got a serial number. It's got a date. It's got a stamp for the purity. Is it 2 nines or 3 nines? Meaning 99.9% pure. The refinery stamp is there. There's an assayer who certifies that it's not counterfeit. In other words, so it's got all these stamps on it. But one of them is the date. Well, gold warehouses are managed on a last in, first out basis. So I fill it up with gold, and then when the gold goes out, I'm going to take the bars, closest to the door. In other words, the ones that I put in last are the ones I'm going to ship out. So what my friend at the refinery told me was he's starting to see bars that are stamped from the 1980s, bars that have been in storage for 30 years or more. That tells him that they're scraping the bottom of the barrel. If you have a 2006 or 2007 bar and you send it out, that means you have a pretty full vault. But if you're sending out bars from the 1980s, that means you're back at the far end of the warehouse scraping the bottom of the barrel. That's what's going on in the physical market. So we have our friends at JP Morgan selling paper gold 100 to 1, but we got people in the physical side of the business who say the shortages are scary. How's that going to end? It was very apparent that at some point something's going to break, someone's going to fail to deliver, there's going to be an exogenous shock, China's going to get their full fill of gold, the manipulation is going to end, something's going to happen. It almost doesn't matter what it is. The setup for a buying panic and skyrocketing prices in gold is there. The setup is there. The catalyst is irrelevant. It could be a war, a natural disaster, an assassination, a financial failure. It could be a lot of things, but it doesn't matter because the result is going to be the same.
Well, Jim, I have one final question for you, and if you do have to go, please let me know, as I know we're at the end of our 30-minute block in your busy schedule. Gold stocks, that's something we focus on a lot at Palisade and Palisade Radio. It's not something that you specifically go into in your book, but my assumption would be that if you see catalysts coming or a reason for gold to come up, that gold stocks being cyclical would be somewhere where you might want to put your money in or have at least given some thought to. Last question for you. What are your thoughts on gold equities over the next few years?
Well, economically, a share of gold, a share of stock in a gold mine is a leverage bet on gold. So in generally speaking, a gold miner will outperform gold in a rising market and it will underperform gold in a falling market. So it's basically a leverage bet on gold, which you can do yourself just by buying gold with leverage, which I don't recommend, but that's one way to do it. Now, the problem I have with miners is that they're not generic. In other words, gold is generic. Gold is gold. It's an element, atomic number 79. We don't have to quibble about grades of gold. It's all the same. Gold miners can be anywhere from excellent to fraudulent, right? So you can't speak about gold miners generically. You have to take them one name at a time. So the thing about these gold mining stocks got beaten down 90% or more between 2011 and 2015. The sentiment was lousy. You just say, how low can they go? The thing about going down 90%, one of two things is going to happen. You're either going to bounce back, skyrocket, or you're going to go all the way. You're going to go into bankruptcy. So I don't want to recommend gold stocks generically because some of them are crooks and some of them are going to go bankrupt. Other stocks are excellent. And if they're down 90% and they're not bankruptcy candidates, then they could double or triple in the years ahead. So they're highly recommended. But you have to take it one name at a time. I know how to do the analysis, but it's not really what I do. I'm more of a global macro analyst. So for gold stocks, people such as yourself, John Hathaway at Tocqueville Gold Fund, Sprott, Casey Research, there are others out there who are doing this sort of work. So I would, I do like gold streamers. Names like Franco Nevada, Royal Gold, Silver Wheaton and others, because a gold streamer, they actually do the hard work that I'm talking about. They go out and visit the mines, look at the financials, meet with management, assess the projects, etc. Obviously, they're only going to buy the good ones, and they're not miners. They just buy royalties and then stream them through to investors. So a good gold streamer is probably a good way to get leveraged exposure to the price of gold without having to figure out the good, the bad, and the ugly.
All right. Well, Jim, thank you so much for taking the time out of your day to come on the show. I can promise to all of our listeners that it's well worth the read. It's a relatively quick read, but it's filled with a lot more detail than Jim's gone into here. And as you can tell from listening to Jim, just a wealth of knowledge on everything gold and a lot of more things. Jim, anything else to add at this point for our listeners?
Yeah, the one thing I say is some viewers and listeners like, well, okay, I hear you, I understand, I even agree, but I'm going to wait till the price of gold really starts to skyrocket, and then I'll jump on board. And what I say to those people is, don't be so sure. You're not going to be able to get the gold. The physical shortages are going to be so severe that if you're waiting for the price of gold to go up to jump on the bandwagon, you may be watching it go up on television, but you're actually not going to be able to get it. So the time to get gold is right now. I mean, I just say to people, watching Russia, watching China, knowing what's coming, all of which is easy to foresee, what are you waiting for?
All right. Well, Jim, if you want to hold it up one more time, the new case for gold, everybody, you can go pick it up, pre-order on Amazon right now. And thanks so much, Jim, for coming on the show.
All right. By the way, it's got a nice gold cover, so it's like you buy the book, it's like getting a bar of gold. So I hope the readers enjoy it. The new case for gold, available now on Amazon. And Colin, thank you for having me on your show.
Okay. Thanks so much, Jim.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen? Or are you too stupid?